You're listening to Money FM 89.3. I'm Chua Tian Tian with your market view. Now, today we are going to bring you all the information you need to know about US markets as we kickstart October. Now, earlier this week, US markets started the month strong after the broad-based S&P 500 and tech-rich NASDAQ registered the first three-quarter losing streak since the global financial crisis. Now, with October widely seen as a bear market killer based on historically strong returns, we'll find out whether stock movements can keep up with the expectations. And joining me as we deep dive into key movements and projections for the US economy, I have with me AJ Kahling, International Education Strategist at TD Ameritrade. Hi, AJ.
Hi, how are you?
Great. And how's things for you there?
Very good, thank you.
Right, so AJ, let's start with the broader US markets. Market seems to be moving away from that brutal sell-off we saw in September. Some analysts, they were saying that that's driven by optimism in the US over the state of foreign markets amid a rising dollar. What do you think is driving up that rally?
Well, I like to always advise our clients that it is best to have exposure diversified across different markets. But as we've seen this year and really for the past couple of years, the US is the place to be. And I don't think that's changed. So, with the strength of the US dollar, that traditionally actually makes US corporations selling their goods denominated in US dollars as more expensive. And so that shows headwinds for those companies. I think we might start seeing that here in these earnings reports, but that strong US dollar also makes other foreign markets outside of the US less competitive. The dollar has shown incredible strength this year, but we did see a sell-off recently. It's been kind of giving up a little bit of ground these past couple of days. I don't know if we can attribute all of the past 2 days gains in the US markets, almost 5% of gains to the declining US dollar, the slight decline in US dollar. I think it probably has a little more to do with, we've seen a lot of overselling over the past couple of weeks, a lot of weakness in the markets. The end of the quarter could have been a lot of investment strategists dumping some stocks that have been performing poorly and reinvesting in some different sectors and pivoting there. So it is very convenient that it happened to land on the first 2 trading days of October, isn't it? That we're seeing this October rally start off, and it's the strongest 2 days we've seen in the past 2 years. So I think it's probably a combination of all those things, plus some decent economic news that we've seen in terms of job reports that have come out over the past couple of days. All those things combined, investors were just looking for any kind of catalyst to start buying again.
Right, and speaking of buying, and do you think that markets are oversold at this point? I understand you briefly touched on that earlier. And if markets are oversold, can we expect pockets of bargain buying in October? Which sectors should we be looking at for bargain buys?
I think definitely oversold is a proper term to use right now. I think
Right.
the S&P 500 was down 25%, NASDAQ down around 30% as of last Friday. Of course, that's changed the past few days there. But I think it's really just if you step back, I think this correction was necessary. From the lows of the pandemic up until the end of 2022, we experienced a 110% market rally. That's not normal, right? Those types of rallies don't happen. And so we were actually due for some overcorrecting. And I know it's been a tough year for everyone. Of course, most of our clients are long stockholders. And so it's been tough, but it's an opportunity to buy the dip. Very difficult strategy, though. History provides no guarantees. But what Warren Buffett says, be greedy when others are fearful. Buying stocks when they're down this big
Hmm.
tends to lead to positive returns, but it all comes down to the investor's time horizon. Are you
Right.
trying to get out of the markets in a week or a month or a couple of years? That all matters when you're deciding if now is the right time to get in or not. Because I wouldn't be surprised if we still see some choppiness the rest of this month. 2 days a trend does not make.
Yeah, exactly. But on that note, let's talk about economic data coming out of the US. We had that job openings and labor turnover survey out last night. What does it say about the state of the US economy? What does it mean for the Fed when considering its next monetary policy move?
Yeah, well, it's interesting. We are in the phase of bad news is good news. I think we haven't pivoted back to bad news is bad news yet. But yes, the JOLTS number came out, and there were 1 million less job openings in the past month than previously. Obviously, you would think that's not a good thing. The markets actually were craving that, right? They
Right.
needed some sign that the Fed's efforts to tame inflation was actually working. And it's going to take some time, of course. We started hiking, a while ago, earlier this year, hiking interest rates, and we were looking for inflation to start cooling off. Maybe crude oil, which has sold off 30% since this summer, would help cool off inflation, but it hasn't yet. And this was actually the first sign that we did see of the economy maybe slowing down. There was also another aspect of that JOLTS figure was the quit rate, which was 2.7%, which is still elevated at this point, meaning people are quitting more than they were recently. It was lower, around 2% prior to the pandemic, but it's dropped a little bit. And that means that people aren't as confident that they will find another job. So the quit rate is starting to slow down. So those two things combined, again, could have explained the rally that we've seen the past 2 days. Again, it's the investors in the market kind of voting with their moves, saying like, we think this is a sign of things to come. The Fed's efforts to orchestrate a soft landing might be starting to show fruits of their labor.
Right. And talking about some optimism over that not so good jobs data showing that signs that inflation might have cooled off, and also talking about oversold conditions right now, where do you see markets moving for the rest of this month?
Choppy. There's nothing that I've
Right.
seen this year to make me think otherwise. We've seen short rallies followed quickly by corrections here. So listen, if you're an active trader, this is great for traders who love to sell volatility. This is what they're looking for. This is what they live for. It's a little bit more frustrating for us investors. I'm speaking,
Exactly.
of course, to the buyers and holders here. If you're a buy and hold person, maybe even a dollar cost averaging person, this month will likely be more of the same that we have seen for this entire year. I mean, because this month, of course, we're going to see earnings reports coming out for the previous quarter. From the very little bit of kind of preview that we've seen, Nike, for instance, is a good one because they report on an off schedule. They released last week their quarterly reports, and they warned about oversupply. So, there's going to be some companies, maybe in the energy sector, who will benefit from this choppiness, maybe some consumer staples because there's talks of recession coming on. But then there's going to be other, consumer discretionary stocks that could be having issues here. Inflation is going to play a big role with their big inventory. Obviously, that inventory is not worth as much as it used to be with inflation rising, and it's going to lead to steep discounts.
Right. If you're just tuning in, we're now speaking to AJ Kahling, International Education Strategist at TD Ameritrade. And AJ, I would like to turn our attention to look at some corporate moves. Now, I was going to ask about Elon Musk having a humanoid robot prototype, and also talking about suggesting Crimea be part of Russia. But earlier last night, we know that Elon Musk is going to buy Twitter. Reports suggest that. So tell us, to what extent do you think this would weigh on the stock of Twitter and Tesla as well?
I mean, first of all, is Elon Musk the most polarizing person in business today? I
It
can't think
is.
of any figure more polarizing. The guy makes trading his stocks incredibly difficult. You know what I mean? Because
Right.
every time you turn around, there is a new tweet coming out from him. Like I said, so Tesla and Twitter are difficult ones to kind of gauge what's going to happen because you never know what he's going to say, and he seems invincible from the regulators. So he makes it difficult. I don't think really his controversial tweets make an impact onto his stocks. Of course, when he comes out and says like, yes, I'm going to follow through with my purchase of Twitter, which by the way, is he really going to do that? He already said he's going to do it. Then he backed away, and now he's saying it's going to happen again. I wouldn't be surprised if there's still some more chapters to play out in this saga here. I think
Right.
really the data is what's really going to drive these stocks going forward. And we saw Tesla showing weakness recently, all due to vehicle delivery data that came out. I think they delivered 340,000 vehicles last quarter when 360,000 were estimated by analysts. And I think that the important thing here, because we want to take out this information and kind of see if we can extrapolate it and make it mean something for the broader markets, it didn't have anything to do with demand For Tesla, it wasn't a demand issue. It was supply chain issues. They just couldn't pump out enough cars to meet that demand. But they're still better positioned than their peers, perhaps. I mean, you look at some of those other electric car companies, NIO, Li, for instance, they're still in the 5-digit per quarter car deliveries, nowhere near touching Elon Musk in Tesla. But they're not out of the woods yet. Of course, there's still competition from the big guys. For instance, Ford just announced that their Lightning SUV truck had huge increase in sales, 18% over the quarter. So you look around at Tesla, they're still the big EV name on the block, but there's still competition out there too.
I see. And in the meantime, AJ, investors keep their eyes peeled on the latest earnings season. Some say this is going to be very critical to see how firms are growing amid a high interest rate environment. What do you think, and which companies are on your shopping list?
Like this is the one I say about, having companies on your shopping list is important. What's on my list or what's your investment time horizon? I was looking at a stock called Roku, which is a digital media player. If you bought that stock 3 years ago this week, you paid $100 per share for it. And now it's worth a little over $60 per share. But in the meantime, it shot up to $290 a share over the past year or so. But if you bought it 5 years ago, you're paying much less than $100 per share and probably sitting on a nice profit. So again, it comes down to what you think is going to happen in the near term or the long term, whatever your time horizon is. What we've kind of been seeing is people more positioned with some of those defensive sectors. If we do indeed have a recession, and by all accounts and measures, we are heading towards a recession, typically the 2-year, 10-year yield, if it inverts, a recession follows in 12 to 18 months. It's been inverted since July. If we have 2 quarters of slower GDP, that's the technical definition of a recession. We've experienced that already. So the point is, whether we're going to have a recession soon or we're going to have a recession full of jobs, we want to position ourselves with maybe some defensive stocks like Pepsi, Kimberly-Clark, and Target have all performed differently this year, down 5%, 20%, and 34% respectively. But they all are kind of necessity stocks that people will probably, products that people will probably still be buying even if there's a recession. Microsoft revenue is still growing, but at slowest pace since 2020. They believe the strong dollar will shave off 5 percentage points off their revenue growth this quarter. So some of the tech stocks out there, like Meta and Alphabet, warned about the digital ad market and surging inflation causing a slowdown in those in the ad spending space here. So the IT stocks, I'm not saying anything new here. Those have struggled in the past year or so because of inflation, because of that high dollar, and some of those other stocks on the defensive stocks have been a little bit better performing.
Right, and AJ, finally, very quickly before we let you go, I understand you also have a Singapore Investor Movement Index, which provides some insights into what Singapore TD Ameritrade clients are buying in the US. What are some key trends and how are Singapore investors positioned in the markets?
I think the key takeaway with the Investor Movement Index that we noticed was that we can compare it to the Singapore client base versus the regular US population client base and kind of contrast how they differentiate. And the key takeaway, again, that I took from this was that the regular US TD Ameritrade population were net buyers in the month of August, where Singapore clients were overall flat. They didn't add any exposure in the month of August, maybe anticipating a slowdown in the month of September here. We're going to get September data here pretty soon in a couple of days here. But the August numbers show that Singapore investors were kind of positioning themselves as a rotating trading base, less so than the US, which was piling on exposure. Some of the stocks that Singapore clients bought were Alphabet, Intel, and Tesla. And the sells were NIO, Alibaba, and Moderna. So, kind of dumping some of those Chinese stocks, whether it's, regulatory concern or just, US-China trade relations, and buying up some of those tech stocks. And of course, everyone's favorite Elon Musk's Tesla was a popular buy for our Singapore client base.
Right. Thank you very much, AJ. That was AJ Kahling, International Education Strategist at TD Ameritrade. Thanks for joining us on Money FM.
Thanks very much. Bye-bye.
Money FM 89.3.